Okay, good evening, everyone. Today we'll be looking at cost of capital. Under cost of capital, we'll be looking at the content, which is the cost of equity, cost of debt capital, calculating the weighted average cost of capital. And cost of capital is an important aspect in SFM, which students should be able to understand very well because it's the basis for most other calculation in SFM. Now, what is cost of capital? The cost of capital for investor is the return that investors require from their investment. That means if you are an investor, if you invest in a company, you're expecting a particular return. So that return you are expecting from the investment in that company is what we call cost of the capital, as the cost of you investing in that business. Companies must be able to make sufficient return from their own capital investment to pay the return required by their shareholders and holders of debt capital. Now, for the company that is collecting loan or that people invest in the company should be able to have enough returns in order to pay the shareholders and equally the debt holders. So we'll be looking at the ultimate goal in the calculation of the cost of capital is to obtain the firm's marginal cost of capital to use in, for example, capital budgeting decisions or in valuation analysis. So the reason why we need to calculate cost of capital is that okay, a company want to invest in a particular project, but they don't have enough money. So what would they do? They can borrow money from banks, which is a form of loan, or issue debt, or issue debentures or bond to the public up to subscribe on. Or, or by venture, they can issue another or a fresh equity shares in the stock exchange. So if they do such, how will they know the cost of capital they should able to make in the new investment in order to for them to be able to pay back the debt they collect from people? So that is why we must able to calculate the cost of capital. Is one, because of what capital budgeting decision. This is a topic that will be treated further when we go on in this course. Now, let's look under the content. Let's look at the cost of equity. Now, the cost of equity. What is the cost of equity? Cost of equity capital can be defined as a minimum rate of return the firm should earn on the net equity fund raised by it in order to leave the market price of the equity of the equity or the required stock unaffected. Now, I want to see the cost of equity capital. We are saying is the return shareholders that those that invest in equity they are expecting from the company. And peradventure, you know that the major objective of a company is to maximize wealth. And how you maximize wealth, you must be able to increase the market value. Now, shareholder also require a return. Now, that return you are giving them should not you should pay that return should not be able you should not reduce the market value. So that's why you must manage the company's efficient in order to ensure this cost of capital that is equity holders are expecting. Now, there are several methods commonly used to estimate the rate of return on equity. There are several methods. One, we look at the dividend forecast approach. Under a dividend forecast approach, we'll be looking at we'll be looking at the dividend valuation model, the dividend growth model, which is the Gordon growth model. Then two, we look at rates of return, realized rate of return. Okay, the three, we look at the capital asset pricing model approach, which is also called CAPM or CAPM. Now, this particular approach is very, very important in SFA for ICANN sake because most questions will be tailored on this, how to calculate the cost of capital for equity using this CAPM. This CAPM will be a topic on its own when we continue SFM. Then the fourth one that you can use to calculate cost of equity is the arbitrage pricing model, which is called the APM model or approach. This also is very important. Then the fifth one, which is the fifth one, is bond yield plus risk premium approach. This approach is not covered by ICANN study pack or ICANN syllabus for SFM, though is another approach used in arriving at the cost of capital for equity. So you should not worry yourself about this approach, but just to know it. Then the sixth is price earning, price earning rate approach. Now let's look at the dividend forecast approach. And under it, we look at the dividend valuation model without growth. Now, how can you calculate the cost of equity using dividend and the market value of the company? So when there is no growth, we said is KE equals to D1 over VE, where the KE is the cost of equity, then the D1 is the annual dividend, while the VE is the market value of shares. Remember that market value of shares we call it is XDIV. Only remember that it's SDIV, not CUMDIV, it's XDIV. What is the meaning of XDIV? XDIV means that if the company will pay a dividend in the near future, the share price must be a price that exclude this dividend. Now, in the question, you are told that the company will pay a particular dividend in the next future. So it means that the market value of that company does include the dividend that we pay in the future. That means the market value as at that point is called the CUMDIV market value. Now, dividend valuation model, when there is growth, that means you're saying that when there is growth means the dividend will increase, not that they are not paying a particular dividend over the years. It means that if they pay a particular dividend in this year, the following year it might increase. So that means with growth. The formula for that is KE equals to D1, opening a bracket, 1 plus G, which is the growth, over the market value plus growth. Now, the growth can be calculated using different approach, which is the growth. When I say growth, the first approach that you can use to calculate growth is by using the Gordon's growth model. What's the Gordon's growth model? This kind of approach, you are using the earnings of the company to forecast the dividend that will be paid in the future. Now, the Gordon growth model uses the formula by saying the G equals to BR. Then what is G? G is the annual growth rate in dividends in perpetual. YB is the proportion of earnings retained. Proportion of earnings retained. Open bracket for investment in the business. Now, proportion of earnings retained means that when some questions you will not be giving this as part of good, you might be giving the profit for the year. You'll be told that the companies pay dividend to their shareholders or they use part of the profit for something else. It means that if the company has a profit of, let me say, 500 naira, and they said they pay dividend of 50%, it means the earnings that is being retained in the company will be 500 times 50%, which is what, 2,500 naira, which is 250 naira rather. Now, that is the proportion of earnings retained. Or if they say the dividend paid is 7%, that means the proportion of earnings retained will be 100% minus 7, which is 93%. Why the arrow is the rate of return that the company will make on its investment. So if you are giving the cost of capital, then you can use that R as cost of capital, which is your KE. But if not, you can use your ROI as your R, which is the return on equity, return on equity as your rate of return. The, the other approach that you can use to calculate growth is called the extrapolation of historical growth. Now, this approach uses statistical model or techniques called the geometric mean growth rate. And now, this geometric mean growth rate is the square the the square root raised to power n minus 1 of EV over V over BV minus 1, where the EV is the value at end of the period for n years, for n years, while the BV is the value at the period of is the value at the beginning of the period. The n is number of years. The n is the number of years. That means you are saying that if the company is paying dividend for 5 years, the n will be 5 years. And you are told that it's from 2000, 2000, 2001, 2002, 2003, 2004. Now, your EV is value at the end of the period. Which value at the end of the period is 2004. While your BV is value at the beginning of the period, which is what, 2000. Then your number of years is 5 minus 1, which is 1 over 4. Now, if that's said, let's look at some illustration. Now, illustration 1. Okay, illustration 1. A company's share are currently valued at 8 naira 20 kobo, and the company is expected to pay an annual dividend of 0.7 naira per shares for the foreseeable future. What is the cost of capital? Now, solution to this illustration, they are asking what is the cost of capital, which is the KE. Remember our formula says KE equals D1 over VE, which is the market value. Then this is very simple. You can just say the KE equals to 0.7 over 8.20. Then your answer will be 8.5%. Let's look at illustration 2, whereby we are giving growth in dividend. Let's look at how it will look like. Illustration 2. A company shares price is 8.2 naira. The company has just paid an annual dividend of 0.7 naira per shares, and dividend is expected to grow by 3.5% in the foreseeable future. So the company current market price is 8.2, while the dividend that was paid is 0.7, and the growth in dividend is 3.5% in the foreseeable future. The next annual dividend will be paid in 1 year's time. What is the cost of equity? To this question, we are asked to calculate the cost of equity. Now, this question has growth. That means we are using the cost of capital using the growth rate. And the formula for that is KE equals D1 over 1 plus G over market value plus growth. Here, our annual dividend paid is 0.7 naira plus, open in bracket, plus 1 plus your growth rate, which is 0.5%. all over 8.20% plus 0.035%. When you use your calculator, you find out that your 0.7% times 1.035 will give us 0.7245 over 8.2% plus 0.035. So your answer will be 12.33%. Now let's look at this illustration 3. Illustration 3. Liverpool PLC has 10 million naira ordinary shares. Details of the company's dividend per share over the most recent 4 years are as follows. So we are giving the years 2016, 2015, 2014, 2013. Then the dividend per shares is 30, 24, 38.5, and 26. The current market price is 2 naira 35 kobo. A dividend of 30 kobo per share is expected to be paid shortly. Look at this question. We are told that the dividend of 30 kobo per share is expected to be paid shortly. That means it has not been paid. That means the market price, which is 0.35, is cum div. So you are required A, estimate the growth rates G in dividend. B, what is the company's cost of equity capital? Now let's look at the solution to this question. But calculation of growth using extrapolation method, whereby the G equals to our EV over BV raised to power 1 over n minus 1, then all minus 1. Now our earliest value, which is 2016, is 30 kobo, while our beginning value, which is 2013, 26 kobo. The number of years here is 2016, 2015, 2014, and 2013, which is 4 years. Then minus 1. So by using a calculator, you will have 1.1538 raised to power 0.3333 minus 1. Then we have 1.04884 minus 1, which will be 4.9%. 4.9%, which is 4.9% is our growth in dividend. Then the B, we are asked to calculate the company's cost of equity capital, where there is growth in dividend. The formula for that is KE equals D1, open a bracket, plus, open a bracket, 1 plus G over market value X div plus G. This formula I indicate that is S div. Normally, you should be able to know where is S div, because we are told that the dividend, which is the 30 kobo, it will be paid shortly. That means the market price is cum dividend. Then the dividend is 30 kobo, open bracket, 1 plus the growth, which is 4.9% over the market value, which the market value is the cum div. Then we have to remove the dividend that will be paid in shortly from the market value, then plus the growth. Then we have 0.3147 over 2.05 plus 0.049. Then using the calculator, you will have 0.1535 plus 0.049. Then your cost of capital will now be 20.12%. Hope we understand. Okay, let's look at the realized rate of return approach. So this approach is based on the premise that the, the rate of return realized by equity shareholders in the past can be regarded as a proxy for the rate of return required for the rate of return required by them today and in the future. The yield the yield the yield on an equity share the yield on an equity stock for the year is RT equals to DT plus PT over PT minus 1 all over close the bracket minus 1, where the RT is the realized rate of return for for the year T for the year T. And DT and DT is the dividend per share for the year T payable at I said DT is the dividend per share for the year T payable at the end of the year. PT is the price per share at the end of year T. Then PT minus 1 is the price per share at the end of year T minus 1 or the beginning of year 1 or year T. Now, this particular rate, I'm giving the formula for you to just look at it. Maybe some later time we'll look at a particular question. But don't bother yourself on this topic, on this particular rate, because it's not actually in ICANN, or ICANN does not cover it, or it's not actually an ICANN scheme. But the particular one that our employers to concentrate more, apart from a dividend model, is the capital assets pricing model, which is CAPM. Now, this particular model is defined as the premise for the for CAPM is that the cost of equity is equal to the return on risk-free security plus the company's systematic risk, or you call it the beta, multiplied by the market price of the risk, which is the market risk premium. Now, when you say systematic risk, I will tell you this is a risk that cannot be diversified, that cannot be that cannot be eliminated, even if you diversify your operation. So it's risk that the company will always be faced. So though uh, when we look at this topic as a whole topic on its own, they will understand the meaning of systematic risk better than this. Let's go. What is the formula for this CAPM? CAPM, which is same thing as your KE, equals to your risk-free rate plus the beta, open a bracket, risk premium, or you call it or you call it the market risk minus your risk-free. Now, so say KE equals to the risk-free rate plus the beta, open a bracket, the market risk minus the risk-free rate. Now, where the KE is a cost of equity, then the beta, which is the BE, is a beta, because it's the beta factor for the company's equity shares. So you'll be always be giving the beta factor for the equity shares. Though there is a formula for calculating the beta factor. That means when we are talking about the risk, RUF is the risk-free rate of the company. Now let's look at illustration one for us to understand CAPREM better. Okay, illustration one: the rate of return available for investors on government bonds is 4%. The average return on market investment is 7%. The company's equity beta is 0.92. Using the CAPM, the, the, the company's cost of equity is what? So, solution to this illustration, look at your formula for CAPM. So, your formula says, now let's solve this question together. Then the KE equals to ROF plus your beta, open a bracket, your ROM minus your ROF, which is your risk-free rate. Now you're looking for the KE. So the KE equals to your ROF, which is your risk-free rate, is a government bond. So when government issued bond, 4%, government bond is always risk-free because government of a company cannot liquidate. So there is no country I've had in this world that has been liquidated. So country cannot be liquidated. That means the bond issued by a company is risk-free. So there is a little bit risk in the bond issued by any country. So our risk-free rate is 4%. 4% plus our beta. So our beta here is 0.92. 0.92. Open a bracket. Our market risk is 7%. So our market risk is 7% minus our risk-free rate, which is 4%. So our KE equals the risk-free rate is 0.04 plus our beta, which is 0.92. So open a bracket. When 0. So 7% minus 4% will give us 3%, which is 0.03. So when you multiply that together, we have 0.04 minus, sorry, plus 0.0276. So our KE equals 6.76%. So that is the answer. So illustration 2. A company's share have a current market value of 13 naira. The most recent annual dividend has just been paid. This was 1.50 naira per shares. Now you are required estimate the cost of equity in this company in each of the following circumstances. A. Using the dividend valuation model and when the annual dividend is expected to remain 1.5 naira in the foreseeable future. B. Using the dividend valuation model and when the annual dividend is expected to grow by 4% each year into the foreseeable future. They see. The CAPM is used. The the equity beta is 1.2. 1.2. The risk free cost of capital is 5%, and the expected market return is is 14%. Now this question is so easy. So let's solve it together. Now let's look at the solution together. One, you have to calculate the cost of capital using dividend valuation model, which is the KE equals dividend over market value. What is dividend? Dividend is 1.5 kobo over 13 naira. So the cost of capital here is will be equal to 11 11.5%. Now the B part, we have to calculate the cost of capital where you are giving the growth. So you are looking at the formula whereby we are calculating cost of capital using the growth rate. Now the formula for that will be the formula for that will be KE equals D1 D1 D1, open a bracket, 1 plus G, close the bracket, over VE over VE over VE plus G plus G. Now where the D1 is your 1.5 and your 1 plus 0, which is your growth, 0.4. 0.4 is your growth. Close the bracket. Over the 13% or 13 naira. 13 naira. 13 naira plus the growth, which is 0.04. Now, yeah, when you say 1.5 open bracket plus 0.04 will be that will be 1.56 over 13%. Please punch your calculator to verify or confirm the figure. 0.4, which is the growth. Then KE equals 0.12 plus 0.04. So our KE, which is our cost of capital, will equals to 16%. 16%. Now the C part, we have to calculate the CAPM is used, right? Cost of capital when you are using CAPM, and the equity beta is 1.2. The risk-free cost of capital is 5%, and the expected market return is 14%. Now here our KE will be equals to, look at the formula. RF plus your beta, open a bracket, which is your RM minus your RF, close the bracket. Now here, your KE will be equals to, what is your RF, which is your risk free? Your RF here, which is your risk free, is 5%. So we say is 5%. 5%. 5% plus your equity beta. Your equity beta is 1.2. 1.2. 1.2. Then your market risk is 14%. Market risk 14% minus your risk free, which is 5%. Your risk free is 5%. Now your KE is 5%. 5% plus 5% plus 1.2, open a bracket. Then we have 9%, which is 0.009. Then our answer will be 15.8%. 15.8%. 15.8%. So with this, we've solved the illustration 2. Any questions so far?